My name is Michael King, and in this video on working capital management, we're going to talk about how to measure the cash conversion cycle. This is going to be sections 23.1 and 23.4 from Booth, Clear, and Rakita. And I'd like to note that the terminology they use in that chapter is different from what's used in other textbooks or by industry. So I'm going to be using the terms days of inventory, days of receivables, and days of payables instead of the acronyms that they use in that chapter. So what we're talking about today is management of cash and equivalents, where equivalents could be money that's invested in highly liquid, short-term marketable securities. And when we're talking about working capital, we're talking about current assets and current liabilities, where these are shown on the balance sheet as having less than 1 year maturity. Current assets would be accounts receivable, inventory, and current liabilities, typically accounts payable. There are other items, but we're going to focus on those three. Working capital management is really about how a company goes about managing the cash that's tied up or that is created through those current assets and current liabilities. So the cash conversion cycle is an estimate of how many days cash is tied up from the time the company buys the inventory and sells it and collects from customers to the time when it pays its suppliers. It's going to be the days of inventory plus the days of accounts receivable minus days of accounts payable. Now the first two of those are called the operating cycle because they have to do with operations. And so you could also refer to this as the operating cycle minus days of accounts payable. Another source of information about cash is going to be the statement of cash flows, which of course shows the end of quarter or end of year change in cash from three different activities: cash from operations, cash from investing, and cash from financing. So again, working capital management is about the management of current assets and current liabilities. And it's critical for the company to understand this cash and what's happening with it, because companies can run out of cash and not be able to pay their bills. So this often happens with fast-growing, profitable companies who may become bankrupt simply because they're not able to pay, say, interest expense on a bank loan or on their debt. And they run out of cash because as their sales increase, they're tying up more of their cash in things like inventories or accounts receivable, which is where they allow customers to pay them with a delay, or they may be investing in capital expenditures, which is a cash outlay. Working capital management is about really managing the cash balances so that they're optimal and keeping an eye on those three different sources, and also understanding what short-term financing has to be in place in order to address these sort of temporary imbalances in cash. So remember that the statement of cash flows is looking at the actual cash inflows and outflows over the course of the year from operating activities, and you see here working capital. From investing activities, which is the sale or purchase of assets, and from financing, which is the sale or repurchase of debt and equity. Now, the statement of cash flows will show from one period to the next, typically a fiscal year or a quarter, how much cash has changed, simply by starting with the beginning cash, looking at cash that's either used up or generated by operating, investing, and financing activities, and that gets us to the end cash. Working capital management is only going to be focusing on this small portion of these operating activities. So let's focus more closely on working capital management. And we're going to be looking at how much is tied up in terms of inventory, accounts receivable, and accounts payable, thinking of them of days of sales or days of cost of goods sold. So here are the three formulas, and let's just take a look at the estimates before going into the calculations. You can see here that for Shoppers Drug Mart, sales has increased from 2011 to 2013. Cost of goods sold has as well. And not surprisingly, inventories go up, so do accounts receivable, and so do accounts payable, which is typical. Now, if we were to use these ratios to calculate the days of inventory, you see that you calculate cost of goods sold on a typical day, which means the annual cost of goods sold, say in 2011 of 6.315 billion, and divide it by 365. And then you can relate that to the amount of inventory, 1.9 billion, to see that the company has 109.9 days of inventory in its stores. As their sales have increased from 2011 to 2013, the amount of inventory in the stores has actually increased marginally, so that they're at around 113.4 days of inventory, which is almost 1/3 of a year, so quite a lot of inventory. When it comes to days of accounts receivable, notice that we're looking at sales divided by 365, because sales is what the customer is actually paying, the price for the customer. And we look at sales on a typical day and we divide accounts receivable by that amount. You can say that the receivables are quite short. In 2011, they're 15.7 days, and this is declining marginally. So what that means is that the customer is being given around 2 weeks, or just over 14 days, to make payments after buying goods at the stores. When it comes to accounts payable, again, we're looking at what the company pays, not what the customer pays, so we're using cost of goods sold. And you can see that the days of payables are around 52 to 54 days, which is how long they take to pay their suppliers. Now the cash conversion ratio is going to be the sum of inventory and receivables minus how long it takes them to pay. And you can see here that it's roughly 73 to 74 days. Okay, so what do we mean by this cash conversion cycle? Well, let's look at it again, this time with the picture. Ideally, a company would order inventory, would then sell it, and then would collect on the inventory, and in the same time, they would then delay payment to their suppliers, so that the payment to suppliers exactly offset how long it takes them to sell their inventory and to collect. Here you can see that there is no gap, because the operating cycle of 45 days is equal to the payable cycle of 45 days. This is not the typical situation. Here is what we typically see. We see that the inventory may take longer, 45 days. After you sell it, customers may take 40 days to pay, or a total of 85 days, and that the suppliers are paid in 30 days. What this means is that there is a gap, 85 minus 30, of 55 days before the company is going to receive the cash. And what this means is that as sales increase, the company is going to have to find a way to finance that 55 days, typically by setting up a line of credit or by setting up a revolver or bank loan. Okay, so final example, let's look at Home Depot versus Lowe's and ask ourselves, who is better at managing their working capital? Looking at days of inventory, we see that Home Depot has around 81.7 days, whereas Lowe's has 92.8. Home Depot has less inventory in their stores. When it comes to receivables, we see that Home Depot collects in about 6.5 days, and Lowe's actually does not offer any credit, so its days of accounts receivable are 0. When it comes to paying their suppliers, Home Depot takes about 38.4 days, and Lowe's takes about 48.3. So remember that the cash conversion cycle is inventory plus accounts receivable minus payable. As we can see here, Home Depot takes 49.7 days, that's their gap, and Lowe's is 44.5. Lowe's is better at managing their working capital, although one could argue that not offering any credit to customers and having days of receivable of 0 is quite an extreme situation, so maybe this is hurting their sales. Anyways, this is how we use working capital ratios to evaluate a company.